Welcome to Hedge Fund Tips with Tom Hayes. I'm Tom Hayes, and this is your 270th VideoCast podcast for the week ending December 19th, 2024. Last one before Christmas. Merry Christmas to everyone that celebrates. We're going to start off with family, then we'll get right down to business. Here's Annabelle's face of shock. She had an incredible weekend. Crushed the 4-day prelims finals at the Rose Bowl Invitational this weekend. Swimming personal best in all 10 events. She kicked off the meet with a 5:33 in the 500 free. Then she went 58 seconds in her 100 free, 28 seconds in the 50 fly, 2.05 in the 200 free, almost broke 30 seconds in the 50 back, 104 in the 100 back, and she kept swimming best times all weekend. The icing on the cake was at finals on day 4. In addition to scoring high point, she achieved what she has been trying to do since January. She went 26 seconds in her 50 free. Her face says it all. At Nova, she has found some amazing teammates, and the competition has really motivated to step up her game. So way to go, Annabelle. Enjoyed being there in Pasadena with you. And Mom, this is at Fox headquarters yesterday. This is just showing you the unbelievable Christmas cheer in New York City. It's fantastic. This was on the floor of the stock exchange on Monday. This is the catwalk, which I'd never been, up top because that's where the studios were. That's with Kristen Scholler. That's where we did the interview overlooking the New York Stock Exchange. So that was a fun experience. Then I had a chance to meet two of my longtime friends for dinner, Kenny Polcari and Ellie Terrett. Ellie gave me my first break on TV. She was the floor producer for the Clayman Countdown for many years. Over 5 years ago, she gave me my first break, and she is the crypto queen. Definitely a must follow if you invest in the crypto space. She breaks more scoops than Baskin-Robbins serves, and pretty exciting stuff. And you all know Kenny Polcari. If you watch Fox Business, he's on every 5 minutes, and Kenny's incredible. And he puts out daily recipes, so give him a follow. This was a beautiful Christmas gift from Stephen Frampton, who does all the incredible videos, everything you see on TikTok, Instagram, YouTube, X, Twitter, LinkedIn, etc. He is the magic creativity behind that, and he put together this beautiful compilation after 5 years. So we're going to listen in here. Welcome to Hedge Fund Tips with Tom Hayes. I'm Tom Hayes, and this is your fourth ever episode number 6. VideoCast number 13, 20, 73, 146, 174, 202nd, 250th, your 269th VideoCast podcast. Get right down to business. They don't give away multi-baggers for free. We continue to burden ourselves with the facts. Down 41%, you can't give it away. It's the secret to happiness in life is low expectations. Know what you own. Smiling so wide, you could eat a banana sideways. Price is what you pay, value is what you're going to get. We don't buy up. When the facts change, you can change your mind. I want you to see how opinion follows trend. Opinion follows trend. How opinion follows trend. Opinion follows trend. Opinion follows the trend. Opinion follows 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 trend. So again, opinion follows trend. My favorite saying, opinion follows trend. You can't give the stock away. You can't give them away. You can buy it at a 71% discount, and they can't give it away. You can't give them away. You can't give them away. 163 million. You can't give it away. The Russell 2000 breaking out to all-time highs. Couldn't give it away. Can't give away the communication sectors. You can't give away REITs. You can't give away PayPal, but now they're coming along. They're going to chase all the way up. You know what you own, and you know why you own it. Disney just made a marginal new low. Oh, because they don't know what they own. It makes absolutely no difference if you know what you own. You don't know what you own, just dump it in the hole. Many people are shaking out of great stocks due to bad headlines because they don't know what they own. Burden yourself with the facts. Just be burdened by the facts and the data. Then I burden myself with the facts. Separate the facts from the perception of the facts. Mr. Market despondency for accumulation, and Mr. Market euphoria for distribution. That's our model right there. It's not rocket science. That's all we do. And that gets that despondent. If you're not in buying, find another business. Despondency turns to euphoria if they still have a job at the exact wrong time. Price is what you pay, value is what you're going to get. The key is price is what you pay, value is what you get. Price is what you pay, value is what you get. Price is what you pay, value is what you're going to get. As I always talk about, price is what you pay, value is what you get. Price is what you pay, value is what you get. With that said, I want to thank everyone for tuning in. We'll be back next week. Have a great one. Bye for now. And we're back. And then on to the media. I had the pleasure to join the great Stuart Varney on Friday, where we talked VFC, PayPal, and some interesting market stuff. And want to thank Christian Dagger and Preston Mizell for having me on, as well as Stuart Varney. Of course, we're going to listen in now.
Much more than that, but now we're up 110 points, about a half percentage point. Tom Hayes joins us this morning to cover the markets for us. Tom, it looks like we're going to get a corporate tax cut. With any luck, we'll get a corporate tax cut. If we get it, what kind of gain would that imply for the stock market?
Well, Stu, if the corporate tax rate comes down from 21% to 15%, it would increase S&P 500 earnings by 4%, meaning estimates for next year would go from 275 to 286, which is a big deal. The sectors that would have the greatest benefit is consumer discretionary earnings would go up 6.8%. Healthcare would go up 4.3%. Industrials would go up 4.3%. Why this is important is we're going to see a broadening in participation. The 493 are going to do well. Correlations of stocks are at a 23-year low. It's going to be a stock picker's market in 2025, Stu.
I don't understand that. The correlation of stocks is at a multi-year low. Explain that.
So we went through a period of time when it was risk on, risk off. The market went up, everything went up. The market went down, everything went down. So you were rewarded for just owning the indices. Next year, with correlations so low, the unmagnificent 493, there are going to be pockets of opportunity, even if the indices are up 8, 10, 12%, more subdued than this year. Those companies, like in consumer discretionary, like in healthcare, like industrials, that didn't do quite as well, are now going to start to participate, because not everything is going to move up and down in the exact same way. Even if tech is more subdued, you can find opportunities in industrials, healthcare, and so on.
We want you to do a victory lap on two stocks that you brought to us. First off, VF Corporation. You brought it to us at 15. Where is it now, and where do you think it's going?
It's at 21 now. It's up about 40% since we brought it to the network. And the whole story here, Stu, is the new CEO, Bracken Darrell, has turned this company around. He sold Supreme. He delevered the balance sheet, got $1.5 billion of cash. They're doing a collaboration, North Face with Skims with Kim Kardashian. It's off the charts. Vans is turning around. This stock is going to double over the next 2 years, and then it could go up from there. Bracken Darrell's a proven winner. He had a 35 bagger at Logitech.
You've got to deal with PayPal real fast. You've got 30 seconds. You brought it to us at 67. It's now at 90. Where's it going?
It's up 35%. It's going to push over 100. Then it goes to 150. This is another bet on the jockey. New CEO Alex Chris came from Intuit, where the stock had a 35 bagger. He has generated $6 billion of cash flow, $6 billion of buybacks. He's improving margins. He's improving take rate. Their checkout fast lane has increased conversion from 50% to 80%. This thing is going to hum over 100, over 150 over the next couple of years. We love PayPal.
Okay, VF and PayPal. We'll check them out. Thanks very much, Tom. Good to see you. Have a great weekend.
And we're back. And then I had a chance to join Kristen Scholler live from the New York Stock Exchange on Monday morning. And want to thank Jeff Cohen, obviously Kristen Scholler, and Melissa Montanez for having me on. We'll listen in here.
All right. right, we are off to the races. The stock market officially open for trade in one of the final weeks of 2024. What a run it's been for the major indexes. The S&P up about 27%. I do want to bring in my guest to talk more about markets. Thomas Hayes, Chair and Managing Member at Great Hill Capital. Thomas, always great to see you, especially as we get set to wrap what has been a very eventful year.
Yeah, no question about it. They're excited down there, and they have every right to be, because I think we're in the period, Kristen, where seasonality is becoming favorable. We just got through tax loss selling season. We saw some weakness there the last week. People were getting nervous. A little bit of anxiety about the Fed meeting this week, but it looks like for sure they're going to be cutting 95% plus odds of a cut this week. So as we move out of tax loss selling season, guess what comes to town? I think we're moving towards the Santa Claus rally, a little bit of strength into year end, despite having such strength all year long.
Yeah, it has been a lot of strength that we've seen here, and expectations, I would say, are pretty high for 2025. How does that set us up in the markets?
Yeah, I think one of the things that is critical that's happening right now is a global easing cycle. We've had 64 Fed cuts so far this year, another one on tap hopefully this week. And that is the most amount of easing that we've seen since 2020 and 2009. So while it feels toppy, those were periods when you wanted to be a buyer of stocks, not a seller of stocks. But I do think it's going to be nuanced moving forward. As a matter of fact, when we look at correlations of individual stocks, going back to 2001, correlations are now at the lowest level. And what that boded well for was not a continuation of tech, which you saw into 2000, but actually a wide broadening, in our case right now, the unmagnificent 493. And what you saw in 2001 to 2007, small caps started to dramatically outperform.
Yes.
And believe it or not, emerging markets, which no one is positioned for, no one's interested in. It's American exceptionalism. No one wants those stocks. But if you go back to Trump 1.0, they did quite well.
Interesting. So you seem to be optimistic on emerging markets. Is that the case, Thomas?
I think you want to have some ex-US. I think you want to have some emerging markets. I think you want to have some non-US. And I think the US will continue to do fine. I think we have to have a little bit slightly more subdued expectations. You know, we're not necessarily going to get 27% two years in a row or plus 23 years in a row, but I think it'll be okay. I do think you'll see some moderation in the heaviest weights in the S&P 500, which will weigh on the indices. So 2025 stock pickers market, if you're in the indices, you're going to be okay. You're not going to be throwing parties, but 8, 10, 12%, you're happy. Underneath the surface, you can make a tremendous amount of money in that type of environment. That's where stock picking, fundamental analysis really come to bear.
Let's talk about some of the sectors as well as perhaps some of the stocks on your radar.
Yeah, I think it's time for XBI. I know we've been on together. I've talked about biotech. Well, they've finally come aggressively off that bottom. It's taken a couple of years to consolidate the losses. And now we're at the level where I think the next phase we're gonna start to move higher. I think you've got two things working in favor: deals and drugs. So deals, FTC is going to be much more favorable with mergers and acquisition, and drugs, FDA is going to be putting things out more aggressively. Couple that with the fact that large pharma has more cash on the balance sheet than they've had in decades, and they have a lot of drugs coming off of patent. So it's much easier to buy innovation at low valuations, historically low valuations in the biotech sector, than build it from scratch, which takes a lot of time. So we like biotech.
What does this mean for volatility?
That's a good question. Moving forward, look, we're at very compressed volatility right now. Historically, what you see is strength into an inauguration, and then afterwards it gets a little choppy. So it wouldn't shock me if we got a little bit of volatility late January, early February, normal pullbacks, 5-10% type of pullbacks, and then a modestly good year for the overall indices next year.
Interesting. And in terms of the new administration, of course, we saw the president-elect here at the stock exchange on Thursday, as well as many different members of his cabinet. How is that shaping your investment thesis, Thomas?
You know, it's pro-business, it's let animal spirits run, it's deregulation. This is a very positive thing. We want to be in those companies that have actually been beaten down. You know, one of the companies we like, which you can't give it away right now, is called VF Corp. Okay, Bracken Darrell is the new CEO for the last year. He came from Logitech. At Logitech, he took a stock that was down 82%, and created a 25 bagger in 8 years. He's doing the exact same thing. He's taken solvency risk off the table by selling Supreme, paying out $1.5 billion of debt. He's got the new collaboration with Kim Kardashian, North Face and Skims, that's going. Vans is stabilizing, Timberland is a solid brand, and Dickies will do okay. So we definitely are betting on Brack and Darrell here.
Is Bitcoin on your radar?
It's not. I'm an equity manager. Kudos, there are a lot of ways to make money. For me, that's not one of them, but I've got a lot of friends that have done extremely well in the crypto space. Very
quickly, in just about 20 seconds, Thomas, anything you want to hear in particular that will shape your thesis from the Fed chair on Wednesday?
It wouldn't. Number one, I think he's got to acknowledge that he's still in an aggressively restrictive stance, number one. And number two, it really wouldn't surprise me if he does pause for a while, and I hope I think the market is prepared for that. Get that cut in. He front-loaded a lot of cuts, and then maybe see what happens for the next few months before you get too aggressively. Let's watch the inflation numbers. But I think maybe one, maybe two cuts may be all that's needed in 2025 after this.
All right, Thomas Hayes, Chair and Managing Member at Great Hill Capital. Thomas, always a pleasure. Thanks so much.
Thanks for having me, Kristen. And we're back. And then I had the chance on Monday night to join Sean Caleb's on CGTN America to talk China or Trump-Xi relations. Pretty aggressive stance on a Chinese station, but I think it's moving in the right direction, and appreciate Sean and Camellia Kilowan for having me on. Enjoyed speaking with Sean as always.
Los Angeles.
Okay, for a deeper dive into the impact of potential tariffs from Donald Trump, let's talk with Thomas Hayes. He's the founder, chairman, and managing member of Great Hill Capital. Thomas, always a pleasure. Good to see you again, my friend.
Thank you for having me, Sean.
Okay, so how likely are we to see price hikes on everyday products? And again, we are presuming that this actually goes through.
Correct. I think this is a negotiating tactic, Sean, as we saw from Trump 1.0. People are worried about inflation, the prices of goods going up, except for the fact that inflation under Trump 1.0 was 1.9% on average. Right now, China is running a trade surplus at a record high of $957 billion. And the impact of any tariffs, if they do go through, is lessened by the fact that the yuan has devalued over 5% in the last few months against the dollar, very similar to what happened after the 2016 election before the 2017 inauguration. So there's a lot of knee-jerk reactions here, Sean. It may prove to be overblown, particularly when you have a president offering one of the longest olive branches in diplomatic history to President Xi Jinping, inviting him to attend the inauguration. And I would say if President Xi Jinping is serious about recovering the Chinese economy, he should accept that olive branch and come and negotiate and make a good business deal for China, make a good business deal for America, and move forward with economic prosperity.
Well, Thomas, there's also no question that Trump has played hardball, not just with China, but with Canada and Mexico as well. And whether or not this goes through, people are planning on it. If you look at the amount of goods that came through the port in just the last month out in Los Angeles, this shows that people are buying now. So what should Americans perhaps plan on buying now ahead of a tariff implementation?
I think if you make a decision, an emotional decision based on a knee-jerk reaction to headlines, I think you're doing yourself a disservice, because that money could compound invested, and if you're not taking it out of the stock market, you don't pay taxes. So if the worst case scenario happened, and as it relates to other countries other than China, and including China, this is all predominantly about fairness and reciprocity. So if Canada taxes us 10% on X, we're going to tax them 10% on Y, et cetera. So, phones, they estimate, could go up as much as 26%, vacuums as much as 19%, gaming as much as 40%, shoes as much as 14%. But you have to put this in perspective, Sean. We have the lowest percent of duties collected as a percentage of total imports in over 100 years. It's 3% of duties on total imports. If you go all the way back, first of all, this is lower than it was under Clinton. It's lower than it was under Carter. It's lower than it was under JFK, not by a little, by a lot. And for all the people worried about Smoot-Hawley tariffs in 1929 caused the Great Depression, at the Spanish flu in 1918, 5% was the total duties collected. We're at 3% now. That grew from 5% to 17% before Hawley-Smoot. So 12 years of economic prosperity before it hit a crescendo. So we have to be careful. I think this is a starting point to bring people to the table. A lot of people have come to the table at Mar-a-Lago to meet with President Trump. Trudeau came down to meet. The president of Mexico called. So let's see what Xi Jinping does. Maybe he will accept the invitation, and we will have a very promising, economically prosperous, mutually beneficial relationship moving forward.
Well, but Trump has also followed through with this in the past. So let's talk about how tariffs could contribute to inflation. Many Americans are just fed up with inflation. That probably cost the Biden or Democrats the election, if you listen to what experts are saying. So is Trump using this as a threat to simply get what he wants? What's behind this?
Well, it's part of it. Look, in Trump 1.0, you had 30 to 50% tariffs placed on washing machines. You had 25% tariffs placed on steel. You had 10% tariffs placed on aluminum. You had 4.1% of total tariffs were impacted by the tariffs he implemented in 2018, and yet the average inflation rate was 1.9% during his term. So some of this gets offset by currency, some of it never happens, it's overblown. But we do have to keep in mind, as it relates to what he's negotiating, a lot of this has to do with border security and fentanyl trafficking. He's saying, stop the fentanyl or I'm going to tariff you.
Yeah, but China has actually said that they will work with the United States on fentanyl. That's one thing that they've said time and time again.
They are starting to do that, but they have said it, and it has not been the case in the previous 4 years. It is now beginning, and that's a positive, constructive step that will go a long way and probably has something to do with the olive branch that was extended to attend the inauguration, which I think President Xi should take him up on it.
It's going to be interesting. My friend Thomas, thank you so much. I really appreciate your insight. Thanks again.
Thank you, Sean.
Okay.
And then on to another topic. I had the pleasure to join the great Neil Cavuto yesterday, and we covered everything from rotation to healthcare. You want to pay close attention to what I say about healthcare and the analogy to 2016, 2017, and its relative trading performance and keeping things simple. So thanks to Jenna DeTomasis and the great Neil Cavuto for having me on. We'll listen in here.
My favorite guest here is a young man. He follows this very, very closely. Thomas Hayes, the chairman and managing member of Great Hill Capital. Tom, it was really not meant to be a comment because everyone is young compared to me. But seriously, I always enjoy hearing from you because you give us a good perspective on this. And I'm wondering now, after these 9 down Dow days, I know we in the media can make a big deal of that, and there's no connection sometimes to the overall tone of the markets. But a bit of a relief rally today. What do you think?
Well, it's interesting. The 50% of the 1,500-point drop in the Dow, 50% was attributable to United Healthcare. As a matter of fact, healthcare relative to the S&P 500 is having its lowest performance since 2008. That was an enormous buying opportunity. So there's some...
And that downdraft of United Health it was happening before the killing of the CEO. But go ahead.
And it's exacerbated. And of the 500 S&P components, 62 are healthcare. The average healthcare stock, those 62, is down 19%.
Wow.
As Mark Twain used to say, the rumors of my demise are greatly exaggerated. This exact same thing happened in 2016 after Trump was elected before the inauguration. Remember, he was going to tear off the Affordable Care Act. It didn't happen with John McCain. And shortly thereafter, you saw biotech rally 75% the next year. Healthcare, the XLV, rallied 40% in the next year. So I think there's going to be tremendous opportunity to take advantage of healthcare. And that's part of this rotation that you're seeing in December. The other part of it is tax loss selling. So what's performed this year? Growth has performed, so there's nothing to sell. People want to sell those after the new year. Some of the value stocks have underperformed, so they're selling in the hole to create tax assets.
So let's play out what we're looking forward to in the next week or two of this year. It's been an incredible year. The Dow, last 9 days notwithstanding, still up, I think, 17, 18% year to date. Can we keep this going in the new year?
I think it's going to be nuanced. I think Santa's going to come to town. We'll see a little bit of strength. Tax loss selling is over.
I don't know. Santa always worries me because he always wears red. You know what I mean?
That's a good point.
Not
Hey, watch out
not
for
a thinning
Grinch
color, I might
the
point
Grinch
out.
is green.
Right.
Hopefully there will be no Grinch this year. We do have strong earnings, but how much of that is priced in is a great question. I think returns next year are going to be slightly more subdued, 8, 10, 12% for the general indices. The other thing that we're
It's
seeing...
still not bad. We're just used to 26, 28, 30%. You know, Goldman Sachs is still saying 3% if we're lucky.
Yeah.
What do you think?
Well, you know, it's interesting. The correlations of stocks right now are at the lowest level in 24 years, going back to 2001, 2002. What that implies is that the 493 are going to start to pick up the slack, which means if tech does perform more modestly next year than it did this year, there's just tremendous ways to make money under the surface. So you have to be, I think, a little cautious if you're too overweight in all the stocks that are working. Some of them have become really fully valued, if not excessively valued in some cases.
You include the Magnificent Seven and tech stocks.
Yeah.
I find it always interesting looking at the Magnificent Seven, even though you get an NVIDIA that goes into correction territory, down 10% or more from its highs. Tesla balanced out the rest of the magnificent guys. Tesla a little under duress today, not much. But how do you play that out there? Because there are a lot of people who, just virtue of the strength of those stock performances, are disproportionately now in tech, a lot.
Yeah.
What do you tell them?
I think you want to look for simpler stocks in 2025. For example, Boeing is turning around, okay? New CEO is turning around the ship. The union problems are solved. The 737 is back online. That stock is starting to take off. No one's even talking about it. It's up pretty meaningfully in the last couple weeks.
We still have those astronauts stranded.
Yeah.
I mean, but that Wall Street doesn't seem to care.
No,
but, you know, let's face it, Boeing still has a whole heap of problems here. But I guess is the sentiment here that it was overbeaten, and is this a genuine turnaround?
No question about it. Look, they have a 10-year, $500 billion backlog. The beauty is it's a duopoly. If you want a plane, you can only get it from Boeing or you can get it from Airbus. And if you say, I don't like Boeing, they were a disaster, well, then you got to wait 20 years from Airbus. So they're going to fix it. Kelly Ortberg at Rockwell Collins, he created a four-bagger in 6 years for his shareholders. So he's going to turn that around. He's going to right the ship. Another simple one is Disney. That's still down 50%. You can't give the stock away. It's starting to recover in the last few months. Again, no one's talking.
How do you play that? You know, because I've asked this before, but, you know, there's that play the dogs of the Dow, for example, and they'll have their day.
Yeah.
But sometimes the dogs can still bark for a while before, or you can get foolishly drawn in and realize, oh, wait a minute, there's no here.
Yeah, I think the key is low to no leverage. That's where people really get hurt, is if they buy too much on leverage. Just buy the position and know that over time, good quality businesses always recover. The number one thing...
So that extends to Disney.
That extends to
and
Boeing.
Does it extend to the borrowers who want to go in and buy some of these stocks then? Or because some of them are borrowing on leverage of their own, margin accounts.
Yeah, I think that's a way to get yourself stopped out and nervous too soon with good quality businesses. You know, good things come to those who wait. Some come faster. The name of the game with a turnaround situation, when it's a quality, durable business that's been around for decades and you know is going to be around for decades to come, is just solvency risk. If there's no solvency risk, which Boeing had a little bit of, people were a little bit worried, but they raised $20 billion of cash, they're going to be fine. And Disney now is cash flow positive on the streaming side of the business. In those cases, just wait and they will start to recover over the next couple of years. You'll be very happy. You don't have to guess the future. You don't have to guess who's going to win the AI game. You just say, it's Disney. Everyone loves Disney. It's Boeing. Everyone loves to fly. It's going to recover. These stocks are down materially from the COVID highs. They're going to come back.
But the rally continues in aggregate, just not as crazy as we've seen.
I think the index holders will be underwhelmed, and I think there's going to be great opportunities under the surface as this continues to broaden. Remember, other than the last 10 days, we saw a real change, real broadening since the summer.
Absolutely.
This is a pause that's going to refresh, and I think we're going to see that 493. And a lot of the money is going to be made in names we haven't been talking about this year, and that's what I'm
493, the other S&P 500 stocks, not just those big sevens.
The other thing is, in Trump 1.0, everyone was worried about ex-US. So no, you can't give away an international stock right now, whether it's emerging markets, Europe. I think there's some value there. I think you want to start to get some allocation. You don't have to go crazy, but I do think what we saw in his first year, they outperformed. So that could be a surprise for 2025, Neil.
Yeah, these global ETFs are already percolating. So we'll watch what happens. Tom, good seeing you. Have a Merry Christmas. So we don't chat again. Thomas Hayes follows this very, very well. When it comes to...
And we're back. And then I had the pleasure to join Stuart Varney once again on Tuesday with regard to Etsy and a couple other retail sales, automobile sales. You definitely want to check this out. We're going to tune in here.
I want to get back to the retail sales numbers we received earlier. Up in the last 12 months, up 3.8%. Thomas Hayes joins me. Hayes, no N. Hayes joins me now. I thought the consumer was strapped, but we've got a strong sales report here. What's going on?
Well, Stuart, the one thing I've learned in this business over the years is never bet against the U.S. consumer when they have a job. They like to spend. What you've seen since the election, consumer sentiment has come up. Consumer confidence has come up. Debt service as a percentage of disposable income is still below pre-pandemic levels and at multi-decade lows. So the consumer is strong. They're going to continue to be strong. And not only are they buying trinkets, now they're buying automobiles because the incentives are going up.
Would you agree with the following? The top 20% of income earners are doing just fine.
Yep.
Middle America, on the edge, struggling a little. Lower income people really in trouble.
That's right. We're seeing it a little bit in the dollar store stocks and their earnings results, et cetera. Walmart has brought down some of the middle income people to spend in their stores. So Walmart's still doing well, but Dollar General, Dollar Tree have struggled a little bit. But I think it's going to get better as that sentiment comes back, the jobs stay healthy, and Trump helps. That was the demographic that did really well under Trump 1.0. So stay tuned.
Okay. We're looking at 2025. Look across the spectrum of all the stocks that you follow and all the stocks that you like.
Yeah.
Give me one that you think is going to do really, really well in 2025. What is it?
You're asking me for my favorite child, but I'll give you one. It's called Etsy. This was a COVID darling. The stock is down 80%. It's the fourth most trafficked e-commerce site behind Amazon, eBay, and Walmart. Most people don't know that. You can only get things on Etsy that you can't get anywhere else, so it's not a race to the bottom. They're still generating over $600 million of free cash flow, and that's starting to reaccelerate. They just announced a $1 billion buyback. They've got loyalty programs, gifting programs. They're focused on international growth and bringing men into the fold. So if you want to do the minimum, just scattershot everyone chocolates that they're never going to eat for Christmas. If you want to make them feel special, get them something on eBay with their name on it. They'll never forget that gift. And that's why we like eBay.
You could move the market with that recommendation. That was very strong, young man. Very strong. Tom Hayes, thanks for being with us. Appreciate it.
Thanks for having me. And we're back again, thanks to Christian Dagger and to Preston Mizell and Stuart Varney for having me on. And then finally want to thank Arshia Singh Bajwa for including me in her article on Reuters on Friday. So it's been a busy week. And what's important is, despite what happened yesterday, everything that we covered in those videos, which covers my total comprehensive outlook right now, still applies, okay? And we're going to talk about yesterday's flush and how we're thinking about things moving forward. It'll be a little bumpy ride when you get that type of a push down, but you know, we try to just burden ourselves with the facts, be dispassionate about things, and pick our spots. Looking at some of these charts, these are some of the indicators we're going to cover more in the article of the week. You look at PMO by all, it's not quite down to zero, so we could have a little bit more pain. PMO by SPX is closer to areas where you see recoveries. Obviously, active managers got over their skis all in the same stocks. Those got hit the hardest yesterday. The put call did spike up to levels where you usually see a little bit of a back off. It wouldn't surprise me to see another faux flush just to get out all the weak hands before we bounce back. But on balance, I think we want to remain invested through the inauguration. And we used the opportunity late yesterday and in after hours to buy some things up at some nice prices. And that doesn't mean we got the last tick. It just means we took advantage. The other thing that I would say is going back to the Trump trade. These are the charts from 2016, from when he got elected to when he got inaugurated. And I just want to remind you on a few of these key. Obviously, emerging markets got hit the hardest after he got elected, all the way through the calendar year before the inauguration, and then they shot straight up. We're looking at BABA here, but it's a proxy for emerging markets. Down after the election, into the calendar year right before the inauguration, straight up. More than a double in less than 12 months. Same with K-Web is the same type of situation. That's Chinese internet, which is basically BABA. You also saw a little bit of checkbacks with the equal weight, which is a kind of proxy for the Magnificent 493, and small caps. Even semiconductors saw a little bumpiness in December before the inauguration, and so on. So this is stuff that we've seen before. Solar stocks, we continue to keep our open mind because they did much better under Trump than they did under Biden, which is counterintuitive. Biotech was like the Wild West after he got elected, sold off after the inauguration straight up. We're going to cover that. Energy stocks back then went straight up after he got elected and then had a bad year the next year. Some of them are getting to points that get us interested, but for now we exclusively are in Comstock, which is up a lot, but it's just getting started. And let's take a look at some of these others just to remind ourselves not to get totally faked out with short-term moves, because this type of volatility, same with tech, you saw some volatility before the inauguration. Staples sold off big. There's some opportunities starting to show up if you look at like Pepsi and Coke. We haven't done anything there, but we don't mind buying high-quality consumer brands when they're on sale, so we'll keep our eyes peeled. Utilities, if opportunities come up, same thing. And healthcare. Look at what happened to healthcare after the election. Remember, this was, as I discussed with Neil Cavuto, this was the period he was going to rip up the Affordable Care Act. So right now, this is the period where, RFK is going to ban all vaccines, which he's told you he's not going to do. He's going to spread out the schedule, do things in a more rational, sensible way, which 99% of people agree with. And the other ones are selling it to you. So the 1%. So this will be fine, and this is going to be a great opportunity. You're seeing it, whether it's the Pfizers of the world, the XBIs of the world, the Baxters of the world, every single thing, the insurers, Centene, etc. They're all beaten down. They're gonna. It's like a beach ball underwater, and huge opportunity there, and so on. So, let's just quickly remind you, because everyone's probably getting sideways about this short-term offsides on U.S. Treasuries and the dollar. So if you look at, he was elected in November, early November, TLT collapsed from 108 to 95. Absolutely collapsed. And then he got inaugurated. It started to rally into the inauguration, bottomed out 2 months later in March, and then started to move straight up over the next couple of years. So, so for those of you worried about bond yields compressing, this is par for the course. Sell off after the election, buy into the inauguration, and it will continue to persist up, and yields will compress. Similar with the U.S. dollar, for those getting faked out today and think that everything's sideways, same exact thing. He got elected, the dollar went straight up until the calendar turned, couldn't go any higher, and then completely rolled over the next year, and that's why you saw emerging markets do what it did. Now, the charts that we're going to cover this week, we've got a lot of them. A lot of them are probably going to be duplicates because I was doing this on the 6-hour plane ride back to California, and the internet was so-so. It was good enough to get the article done, which I think was a pretty good and timely article. We put that out at like 9 o'clock last night when futures were still down. I don't know if it was Pacific. The time kept changing when we were in the air. But long story short, we got it done, and that was pretty timely and a pretty unconventional view when we put it out. Okay, so this is bank lending. We can skip that. This is S&P 500 advanced decline percent. As you can see here, it got completely flushed towards levels that you see near bottoms and bounces, so that also bodes well. We covered a lot of our own in the article of the week. Here is the McClellan oscillator. Again, these are areas that you get bounces, not you can go further, but the risk reward starts to get interesting. Then you have the healthcare sector. This is going to be the most important chart that we cover this week. The lowest relative performance of healthcare to the S&P since the 2008 lows. So that is, and that was a generational buy opportunity. We'll talk about that. This is election years seasonal composite. So what did we see here? We got some move higher early December, some hard chop in the middle of December, and then after the 21st, straight up Santa comes to town. It wouldn't shock me if that turns out to be correct. So let's see if this holds. This is since 1928. This normal mid-December chop is pretty darn normal until the 21st. So we're at the 19th. So maybe tomorrow's weak again, and Monday mix, and then maybe we get a little turnaround Tuesday action. The reason this chart keeps repeating is I think there was a header put into the mix when I was putting this all together, so we'll just ignore it. Bull and bear indicator is not at an extreme, so we keep it in mind. This is from HeartNet. The contrarian view, the price is right. He's talking about 8 shares outperformed the S&P in 2024. China trade surplus just hit a record high at 957 billion. China's share of global car production up 1% to almost 40% the past 20 years. Okay, so his point here is Trump wants growth, not inflation. And if consensus too fearful of Q1 tariffs, China stocks set to outperform more, entry point for international in Q1. So HeartNet's making a big call. It's time to buy China stocks. China financial conditions are the easiest since June of 20. That was right after the COVID lows. We know the big rally we got into 2022. And when was the last time that China conditions, and people don't realize how easy conditions are in China, because it feels like there's a new headline every day. They cut this ratio, they cut this interest rate, they do this half stimulus, and they do all this stuff. But it's adding up, ladies and gentlemen, and it's adding up to the point where you get massive rallies. Let's just take a look at the last 3 times that financial conditions were this easy in China. What happened? So May 2020, and all I really care about is BABA, so let's just do that. Okay, so you had May 2020 that shot up from 190 to 312 in less than a year. And then prior to that, the last time financial conditions were that easy was November 2016. That's right here, ladies and gentlemen, which, by the way, this is the analog that we've been using here. Let me just show you for the new listeners. This is really interesting how a lot of these things are linking together. Doesn't mean they'll work perfectly, but it does mean that history does tend to rhyme. Take a look here. Okay, so November 2016 is right here. That is the last time you had financial conditions this easy. We covered May 20th, so that was like a huge move, 100 points in less than a year. But going back here, it's interesting. You're seeing the conditions, exactly the same thing. You have this break and then this lower low. And November 16th is when Trump got elected. So like right now, you had BABA starting to get recovered. Then Trump got elected. You were down for a few months, and then at the turn of the thing, so straight up from 85 to 200 and change in just about exactly a year, 84 to 207. And it's very interesting because BABA's recovering off these lows just like it was. Trump gets elected, 3 months down. We're in the 3rd month down, and then straight up for 12 months. So doesn't have to repeat, but conditions are very similar. And now that you can see it empirically, that financial conditions, this is average of percentile ranks of China 10-year government bond yield, RMB, and oil price since 2010. And when you get to that, and then let's go back to 2010. You can't see, Alibaba wasn't there, but let's just see Hang Seng. Going back to that. So you can just see that this is a regular occurrence, 2010. So you had some strength there as well. So here's 2016 straight up. And now here we are in December of 2024. And maybe the other one wasn't the most important chart. This is probably the most important chart that we're going to cover until we get to the next most important chart. China trade surplus at record high, 957 billion. Then we've got China equities, the biggest inflow in 9 weeks. That was from last week. So you got that. And then S&P is skewed by expensive mega caps. The average stock trades near a record discount to the index, greater than 1 standard deviation below average. That is a big deal, ladies and gentlemen. And when's the last time we saw that? Our favorite year, 2001, 2002, which set the stage for emerging markets and international to outperform along with small caps. Gap between cheap and expensive stocks is wide. I mean, this extreme is becoming severe. And if AI is going to be as great as everyone is expecting, it's just going to take longer like it always does. Just like Amazon is as great as everyone was expecting from 95 to 2000, except it dropped 90% before over the next 15 years it became as great as everyone expected. And the same thing's going to happen with a lot of these AI stocks and everything else. Value trades at a discount to PE. So again, you got to go back to 2001, 2002. This is just setting up perfectly. Same on price to book, same on price to sales. It's all there, ladies and gentlemen. And if you don't take advantage of aberrational periods like this and load the boat, and by the way, you should do whatever you're going to do. I'm just telling you how I think. Go to hedgefundtips.com, click on terms. This is opinion, not advice, as always. But this is how big money is made. Here's what we saw. We got to December. Everyone's smiling so wide we could eat a banana sideways. And then guess what? You have this equal weight gets smashed for the first half of the month. And just like it did in the end of October, and just like it did at the beginning of September, and just like it did at the beginning of August, and then it always bounces back. So all our stocks are coming back. They'll be back. And that's the story. So, but this is just a normal, weird rotation that just keeps happening. It happened this last time Trump got elected as well. Moving on, this is the 10-day advanced decline line. You can see it's oversold here, due for a bounce. This is the NASDAQ NYSE McClellan oscillator. Again, these are areas that you get bounces from, and we got there last night. Here is the small cap. Filled this gap. Maybe we'll start to get a bounce off that in the next few days. VIX got up to 27. So these are flush outs, and we'll talk about it in the article. I think probably a fund blew up. Certainly a lot of Momo people on leverage got smoked. The margin clerks had a field day yesterday. Here's the Mag 7 with a 6.1% plunge yesterday. That's huge. That's from Mike Zaccardi. Same with this is rate of change. Again, this is what you see towards buyable lows. Advanced decline percent, same thing here. These extremes, you start to get a bounce. These are the charts that we've just covered with the PMO by all, PMO by SPX. Dow Jones down 10 days in a row, longest losing streak since 1974. Half of that, as I said with Neil, was UNH. Boeing was up, Disney was up, etc. Here's ISM Manufacturing versus S&P 500 EPS annual change. You can see here with earnings going up, the ISM Manufacturing will follow, and that is very good for the overall economy, and it sets the stage for an economy like we saw in Trump 1.0, where everyone participates. The lowest end of economic people start to do better than ever in terms of real wages, and we're going to start to see that moving forward as well. U.S. retail sales was driven by motor vehicles, and motor parts drove the bus. This was the big thing that led to the retail sales beat. Incentives are going up, volumes are going up, inventories are going up. This is all perfect for Cooper Standard. This also helps advance auto parts, as the average car on the road is now 13 years. Retail sales strengthen on jump in motor vehicle purchases. We love the sound of that. Atlanta GDP now is still tracking at 3.1% for Q4. So if you're perplexed as to why Powell curbed your enthusiasm and said we're going for 2 cuts next year instead of 4, even though we've been saying that for 2-3 months on this podcast, the economy's holding up, and he'll be data dependent. You can see how quickly he pivots. Whether they should have taken 2 cuts off of the SEP dot plot or 1 cut off, coin flip, but since he had 1 dissenter, he probably thought it was good to go hawkish. China pushes back against bond frenzy, sends yields climbing. We said these are the things that we would see as the rally starts to recover. It's the same thing we saw in early 2017 before the inauguration. Yields will start to go up. The RMB is going to start to go up. China economy-wide prices in longest decline since 1999. Again, these were times 2009, 2016, 2001. These were times to be buyers of Chinese equities, not sellers. China's 2-speed economy. Industry is soaring. Consumer is lagging. That will catch up, and those things are in the pipeline. NASDAQ getting close to the top of this top-end range. I don't put much credence in these type of lines drawn on charts, but it's always good to pay attention to. Mega cap growth and tech positioning is, one standard deviation above the median going back. They don't say how far going. Going back to 15 years. And these are when you see these type of extremes, like late 2001. That's when tech starts to sell off. I'm not saying we're there yet. I'm just saying be mindful if you're in indices that have forced you to be overweight these names. They keep going until they don't, and when they don't, they don't give you a warning signal to let you know it's time to get out. They get you out harder and faster than you could ever imagine. Economic surprises could be turning in favor of global ex-US. That's exactly what I talked about with Neil Cavuto. The economic surprises, US minus G10 are at an extreme, US dollar at an extreme, and these things will be turning in 2025 in our view. This chart I thought was pretty interesting. 4 main types of AI. You can start to learn about that. This is going to be a 15-20 year trend. You will have a shakeout before all these things come to be realized. But all of the dreamers right now that are buying things up, 40, 50 times sales, they are going to be right about the theme. They are going to be wrong about where they bought it. And just like we were buying Google and Amazon hand over fist in fall of 2022 when everyone was puking it out, and March of 2023, and made double pluses on those easy. We will be buying a lot of these stocks when they're down 80, 70, 80% that have good businesses that are temporarily impaired, and we will rinse and repeat. That's what we do. Will we be buying them when they're at 40, 50, 60 times sales and going to 80, 90, 100 times sales? Hell no, because that's just gambling on, can I get off the train fast enough? And when you're managing decent size, the answer is it's hard to get off the train fast enough. Yen is at its cheapest in 50 years. Again, you go back to these points in time. This is an extreme that will reverse, and we will take advantage of it. On to the next. China may deliver the biggest rate cuts in a decade in 2025. That's from Bloomberg. We covered the China fiscal financial conditions easiest since June of 2000. Again, print this chart out, put it on your wall, and when you get nervous about the day-to-day movement in price, just go back and look at what happened to Chinese stocks. Every single time financial conditions got this easy, what happened 3 months later and a year later and 2 years later, and you will be smiling so wide you could eat a banana sideways. Number of protests is up. This is further pressure for them to take action. Market cap of the Magnificent Seven as a share of the total index. I mean, this is crazy town, ladies and gentlemen. You can see it, and you can decide if you want to continue to play on the skinny branches. Wave of stronger productivity growth starting. This is great for manufacturing. The global economy, for people at the lower levels of income, are going to start to benefit from this. This is what keeps the economy humming along. Pretty exciting to see that. Tariffs, we've covered 1 million times at 100, 200-year plus lows. Everyone's saying we're going to start a trade war and we're going to go into a depression, except we started in 1918 at 5%, went to 18% before Hawley Smoot, and that's that. So beware of the people who are speaking emotionally and unburdened by the facts. They will lead you astray. 10-year yield, so it's up against this trend line again, probably poke through just to mess with everyone. This will roll back over. This is Trump 1.0 is the same as Trump 2.0. It's just crazy town until the calendar flips and the inauguration. So deal with it on the bonds, deal with it on the dollar. We bought some TLT yesterday, and we'll leave it at that. Equal weight. So here we go. The mid caps came down to this trend line or whatever they call it. Small caps came down. So, whether you're buying it down at the red line or you're buying it here, it really doesn't make any difference in the scheme of things. Industrial. So you can just see some of these sell-offs. Semiconductors. Here's pharma. This is part of the healthcare theme we're going to be talking about, along with biotech, which we own. Quotes of the week. Warren Buffett, great investment opportunities come around when excellent companies are surrounded by unusual circumstances that cause the stock to be misappraised. This is the credo for Great Hill Capital. This is all we do. This is our knitting. We don't veer. As I said a couple of weeks ago, when God handed out FOMO genes, he skipped Tom Hayes. There's so many ways to make money. I do not get fear of loss when people are making lots of money in a short period of time doing other things. I just love what we do. I can sleep well at night, and I know over time with low leverage, we can outperform materially over reasonable amounts of time. Ben Graham, the intelligent investor, is a realist who sells to the optimists and buys from the pessimists. That's what we do. And Charlie Munger, great investing requires a lot of delayed gratification. The beauty is usually the more delayed it is, the greater the gratification you get. And that's the other thing that most people don't understand. A great example is when he did BYD, the Chinese thing. He got Warren to put, I think it was like 200 or 300 million of Berkshire money in. It had 50 to 80% drawdowns over a decade, did nothing, and then was like a 12-bagger in 12 months from 2000 to 2002. So the IRR turned out to be just fine, and they were patient and did the thing. Bill Gross, the market can move for irrational reasons, and you have to be prepared for that. You need to make big bets when the odds are in your favor, but not big enough to ruin you, but big enough to make a difference. And we always say that anytime we put a position on, regardless of how slam dunk it is, we always account for what you don't know that you don't know. If this position ever went to zero, would they carry us out on a stretcher? And the answer always has to be no. The second question we always ask is, if we were to walk into the boardroom of this company and offer to buy the entire company, financed by JP Morgan, we would be the equity at the current market price, would they call security to have us escorted out because we were offering a ridiculously low price? The answer has to be yes. And that's why I stick in public markets, because private markets will never offer you the type of irrational pricing on the downside and on the upside that you could never ever experience in the private markets, because people would look at it rationally. And for some reason in public markets, they look at price movement and they think it tells them something when they should be looking at financials as if they were buying a normal business. It's basically private equity in the public markets, and no one does it. We do it. We love it, and we'll always do it. So that's that. Boeing commits $1 billion to speed up Dreamliner production. The 737 is back. We talked about that. Alphabet and 9 more stocks to buy for 2025. So guess what was the number one stock that Barron's put Alibaba Group Holding. Let me tell you who didn't write this article. Actually, for those of you who have been following, you know who didn't write this article. But Andrew Barry wrote it. Fantastic. And they say that basically, they're being conservative here because they're putting themselves out in period. But that's what makes Barron's great. And that's why it's been the best paper for over a century as a as a financial publication. Alibaba stock could be up 50% in 2025 if investors warm to the depressed China stock market. There are other reasons, and I think it'll be up even more. And they reference David Tepper, largest position, etc. This came to me from Jeff Adams. Drop everything to join the wait list for the TikTok famous Skims and North Face ski collection that has sold out in hours. Bracken is crushing it. Collaboration with Kim Kardashian. This is absolutely amazing what they're doing. And by the way, now where I am, when I drive my daughter to swimming in Irvine, they've got this huge Vans headquarters there. I'm going to go see them. But pretty exciting stuff that we're seeing happen here. Trump meets TikTok CEO after saying China, U.S. can solve all world problems together. So maybe it is pre-COVID bromance has a chance in 2025, according to Bloomberg, which keeps logging me out. China's regulators vow to stabilize property stock markets. We've heard it before, except for the fact that it's showing up in the data. And by the way, we missed a few charts here. Let's just make sure. Here is high yield spreads at a record low. This was the changes in the Fed speak. So you saw this dissent from Beth Hammack, who was a non-voting member. And then they added this words in considering the extent and timing of additional adjustments. So we know the results. You can see the NASDAQ and S&P here. Just want to make sure I didn't miss anything after that. So you see the pullback here. These are kind of normal pullbacks. We saw it in September. Saw it in July, we saw it in March, and we also saw that this gets extended, stops above the 20-day moving average. Here's semiconductors. So when you visualize this, here's the VIX to cash to VIX 3-month ratio. It hasn't got this high since early August. We know that was an abrupt correction on the Bank of Japan hike, and then they walked it back, and it worked. Here's global stimulus, fiscal plus monetary impulse, percentage points of GDP by GDP weighted contribution. And there's just showing that there's a lot of stimulus moving into the market now and so on. So back to this. This is a great article that one of my clients and friends sent. How Elon Musk and Taylor Swift can resolve U.S.-China relations. This is by Thomas Friedman. And he's just amazed. He went over there and saw all the amazing things that they're doing for manufacturing. Read this article in the New York Times, and you will be as impressed as I was. Here's from a hedge fund manager in Asia. China may be poised for a decade-long bull run. I agree with him halfway. I think it's going to be 5 years and done. And then article of the week, healthcare left for dead, stock market and sentiment results. So here's that healthcare chart that shows the relative performance of healthcare to the S&P at the lowest level since the great financial crisis lows. And here's what I wrote late last night, which was, first move, wrong move, question mark. And I said, well, just when I thought I was done with the article of the week, Chair Powell hosted the Fed presser and made things interesting. I've been doing this for a while and have come out several times after Fed meetings saying, quote, the first move is often the wrong move. I think it may apply once again, but could take a few days to play out. This afternoon felt, I wrote this just after the close. This afternoon felt either like a fund blew up or margin clerks were taking a bunch of dumb over-leveraged money out to the woodshed to put them out of their misery. Tell me how you really feel, Tom. We used the opportunity to top up positions across the board, end of day and after hours. This is not to say we got the last tick, as I'm sure we will see some retail selling in the morning as well. but in selective spots we bought, the margin of safety is so large that the downside is limited. I live for days like this. I got to tell you, I do live for days like that. I do not think this is a December 2018, like when Powell said that we're going to put it on autopilot, and he tanked the market 20% right before Christmas. As we've been saying on the podcast, not to expect more than 1 to 2 cuts in 2025. Today, the Fed confirmed it with their dot plot and summary of economic projections. If you're wondering what drove the markets crazy, it was this little green circle. So they took the September projection. The September projection was the Fed funds rate would be down to 3.4, which would be accommodative. It's estimated that the neutral rate is 3.5. Now they took it up to 3.9. So they effectively took 2 cuts off the table for 2025. Neutral rates are estimated at 3.5 level, which Fed is neither restrictive nor accommodative. This implies that the Fed will remain somewhat restrictive in 2025, but does not guarantee it. It was not surprising to us, but apparently it was to those who are levered long in Momo stocks and shiny objects. So when the fundamentals are irrelevant due to structural force selling, I look to some technicals to see when the bleeding might begin to coagulate. I found a number of indications that we could be nearing that point, and others that were mixed, leading me to think it could be a couple-day event, but not a couple-week event. Hence, accepting imperfection and beginning to take advantage of opportunity where it makes amazing sense in the intermediate and long term. Here's some of what I'm paying attention to at the moment. So here's the NYSE 10% volume index. Again, these are levels where you usually get bounces. Dow Swendlin trading oscillator volume. Again, this is pretty extreme. Pring emerging market diffusion indicator. Again, where you tend to get bounces or near bottoms. Then you got the material stocks above the 20-day moving average. It's down to 0. So if you don't have any material stocks, this is the time to be having material stocks. We have Albemarle, and you could kind of count Comstock in that bucket, but not really. Same thing with healthcare stocks above the 20-day exponential moving average, down to 6%. Again, you get down to these levels, you get massive bounces historically. The NASDAQ advanced decline issues down to negative 3,000. This is where you get bounces. NASDAQ McClellan oscillator here, again, down to levels where you get bounces. Same with the NYSE McClellan oscillator, levels where you get big bounces. And then finally, the NYSE advanced decline volume is the lowest level we've seen, even more than COVID. It hit negative 4,000. That's mind-boggling. So many of these are stretched or near levels from which you would normally see a bounce back. Given my thoughts above, nothing changes in outlook for each of these different interviews, which we already went through. This is an important chart that we covered last week, but again, I want to re-emphasize that the backdrop for stock pickers is the best in 25 years with correlation of stock performance at all-time lows. These are periods when ex-US and emerging markets and Unmagnificent 493 dramatically outperform. These are periods where the concentrated stocks at the time, like Cisco and Amazon, they all took corrections. Even though ultimately the theses were right, the valuation and timing was wrong. Valuation too high in certain pockets. So you can see here, S&P price to book ratio now exceeds March 2000 high. Again, do I want to take that bet and say this time is different? The answer is no. There's too much other stuff to do that I don't have to wake up at night and check the futures overnight and sleep with my eyes open. 2 picks, bet on jockeys plus 1 sector pick. We covered VF, PayPal, XBI. Covered the Xi-Trump relationship, covered Etsy, and covered Boeing Disney. Why healthcare is not dead. The rumors of my demise have been greatly exaggerated. We talked about 62 of the 500 components in the S&P being healthcare. We're down about 20% on average each. That's crazy town with the market at all-time highs. That's where I sniff out opportunity. Last time you saw that extreme where it was 2009, which was a generational opportunity to buy healthcare and biotech. I think you have to be selective, but it's also curious because healthcare is expected to have the second largest earnings growth next year at 21%, and you can't give these stocks away. It's mind-boggling, except when you think about, oh, okay, people are worried about RFK, just like they were worried about Trump in 2016. And the thing you have to keep in mind is whether they're Republican or Democrat, a lot of the public servants are bought and paid for by pharma. So we'll get some stuff done at the margins, but it's not going to be material enough to be as bad as the stocks are reflecting, is what I'm saying. And you could see here, healthcare got smashed after the election, and then after the inauguration, up 40% in the next year. And same with biotech. We love our XBI, smashed after the election, up 78% in the next year. Same with medical devices. Baxter Baby, smashed after the election, up 50% in the next year. And that's all you need to know, with the theme being deals and drugs, FDA and FTC being more lenient, and pharma having a big problem with patent cliffs and a lot of cash. Why Baxter is not dead, which is a part of the healthcare sector. So I just kind of tried to burden everyone with the facts here. You can see here a history of cash flow rising, cash flow falling. The last time cash flow got this low was 2016, and then the stock recovered materially from 30 to 86 over the next few years. And you can just see throughout history, revenues are continue to grow. Return on capital is a little compressed. Margins are a little compressed. These are normal cyclical things. And then you look technically, you're like, this is so oversold. What's going on technically? And you can see every time you got to these extremes, whether it's RSI, stochastics, etc., it was a basing period. Here it took a couple of years. It's been going about a year and a half here, and then it just starts to go. And in this case, the next move was a 20 bagger. In this case, the next move was a 15 bagger. And we'll see what happens here. I mean, we get into things for doubles and triples over a few years, but this one might be good enough to hold for the long term. You could see, certainly cash flow's down, but it's not out. And with the turnaround, all we look, especially, with the stock down this materially, with a turnaround, what we look for is solvency risk is off the table, which they just did with selling the assets and paying down debt. And that free cash flow is positive for the most part, or it's only temporarily negative, like was in the case of Cooper Standard, but that was just we had to get involved when we did. Otherwise, we would have missed the catalyst. And so this one, you can go through this, but you can see on balance, share count's effectively the same. It's down from 2010. It's up from 2021. But not materially. And then debt, they're going to pay down a bunch of this, so you can take that down. That was a worry for a little while. Again, solvency risk. You can read about their moat in the different parts of their business, which we highlighted the important parts. We're not going to go through. We'll be here till dinner if we do that. Key points from the earnings call. You can see the revenue's up 4%. They're growing. These are all things that are fixable. This business is impossible to destroy. And they've tried, but they failed. So it's starting to reaccelerate. And they worked overtime to try to destroy it, just like at Intel they're doing, and some of the others. Boeing, they tried every day and night to crush it. The stock's now going up every single day, even in a weak market, which is exciting to see. And what's more exciting is no one's talking about it, which makes me extra happy. That's one of our biggest positions. So free cash flow is positive. It's down, yes, but if you listen to the conference call, you'll see all the great things. But these are the two key things I want to see in a turnaround: is improving balance sheet, solvency risk off the table through asset sales, and free cash flow is positive. That gives them the runway for operating improvements to take hold. And that's why you get the doubles and triples, and you sleep like a baby at night, because you're buying businesses with long-term operating history that have shown that they have a durable, sustainable moat. And that's why we're looking at 30 years of data here. Actually, not 30 years. We're looking at 25 plus 15, so almost 40 years of data. And they'll be here for another 40 years. So that's the story here. On balance, margins have been good. They're a little compressed, but they've got the plan to move forward. The analyst that I cited here is talking about margin expansion moving forward and why it was compressed. So everything in good stead. On Tuesday, we put out a summary of the monthly Bank of America Global Fund Manager Survey. This month, they surveyed 400 managers with $450 billion under management. Here were the key points. Number one, most bullish catalyst for 2025 could be China growth accelerates. We agree. No one wants healthcare, materials, or energy. Opportunities to be had for sure in materials and healthcare. Energy, look, we love our Comstock. We're going to stick with it. We're keeping an open mind, but a lot of them haven't gotten cheap enough for us to get excited. Best performing equity index of 2025. People are looking to some small caps and starting to look to China. So that's a positive thing. A little bit of love in 2025. Managers seeing some potential for that. Global economy, again, improving sentiment, but not extreme sentiment. So that's a good thing to see. And then global profit expectations, again, elevated like you see off big trough lows, but not extreme yet. So I think there's some runway there, certainly through the inauguration. Then we should get a garden variety pullback is our best guess. And then Cooper Standard update. This was exciting to see. Thanks to my buddy Alan for sending it over. Perfectly on track here. Nothing more to add. And here is the Cox document he sent over. I follow Cox, but I didn't get this one, and or I missed it when I was whatever. Long story short, what are you seeing? Interest rates are coming down. Borrowing costs are coming down. Mobility costs are coming down. What's going up? Light vehicle sales. The sell-through is going up. December, it was 16.5 million on an annualized basis. So let me just see here. Times 1. Okay. So what's beautiful about this SAR at 16.5 for that 1 month, we got a little pull forward probably from the hurricane. So let's just be, curb our enthusiasm. But the beauty that's happening, and this is what I was saying 2 years ago, is if these American automakers don't start selling $30,000 cars and $40,000 cars, the Koreans are going to come in and eat their lunch. And now it's a race to the bottom. I mean, every car you get in, if you're doing an Uber, is like a Toyota RAV4 or, a Kia, I don't even know what they call them, or a Toyota Corolla or whatever. And so this is where the money's being made. And if you look here, incentives are going up, transaction prices going down, affordability improves, credit availability expected to expand, wage growth expected to continue. Auto loan rates are now down 100 basis points from their peak. New inventory continues to expand, and incentives are increasing. Incentives are the biggest leading indicator of volumes, and this is their industry projection for 2025 is 16.3 million. So if you remember, I talked about 15.8 being their basic break even. And effectively, their fixed costs are in place, which is why we always talk about the operating leverage. So if you look at, if they're right with a conservative 16.3, let's say 16.5 doesn't continue, 16.3, that's 500,000 cars, which is effectively all goes to the bottom line, okay? The material costs are nothing. All the fixed costs are in place. So you've got, even if you take the low end, let's say 150 a car, 500,000 cars divided by 18 million shares, you're talking about $4.16 of earnings. And if they can do $4.16 of earnings next year, and it looks like a growth story, and the market starts to price in 7 the next year and 9 the next year, etc. I mean, even on that scenario, and that's $150 a car. What if they're doing 175 if it's more hybrids and more EVs and etc.? It could be better. But let's just say on 4, their trough multiple was 10 times, their peak multiple was 20 times. I think it's going to be a great year for Cooper Standard next year, and that's where it is. So good things come to those who wait, and those who wait longer, the gratitude is the good things are even better. So that's the story of Cooper Standard. We're very excited to see that stuff. fear got flushed out down to 34. Could go lower before it goes higher. We'll take a watch and see. National Association of Active Investment Managers. That was up to 90 and change. Let's just see where it got to. I think it was at a peak. So we got to curb their enthusiasm. And then we will, it's amazing. If you take the daytime flight from, I take it out of John Wayne, which is beautiful. It's 10, 15 minutes from the house. If you take the daytime flight, you don't get jet lag, which is pretty awesome. Let's see here. National Association of Active Investment Managers. I was always worried about that. I'd lose 2 days or whatever. Nope. Hit the ground running. All right, so it was at 82.50. I guess that printed today. Let's move to, all right, we're cruising along here. Some of the data. GDP came in stronger, 3.1. Initial jobless claims came in a little bit better than expected, etc. So nothing critical there. Earnings are still holding up, 275 for next year, mid-teens earnings growth. Exploration and production earnings down 7.9%, top 30 weights in the last 60 days. So again, the price has to come down a lot for me to get interested. And then industrials down 2.2%. Let's see. If I'm not I'm going to guess that's probably Boeing. Let's just see if there's one that's really, Boeing. There you go. So that's already priced. That was priced in at the 140s and 150s, and now it's back at like 180 and on its way. So, wow, it got down to 137. I mean, felt like we had to buy stock every single day, and now it's moving. All right, so that's the story. Let's get on to, by the way, for everyone who, the podcast is over, for everyone who likes to stick around for the Ask Me Anything, I think last week was the best Ask Me Anything we've ever had. Pretty amazing to see some of the quality coming through here. Here's from Vincent Centmore asking about Yeti. We've covered Yeti a million times on this show, and we continue to think that the financials look great, and we continue to do nothing because we just can't really get our arms around the durable moat and the non-consumable nature of it. But I get it. It's jeez. Every time I look at it, I say the same thing. Why don't I own this? And I continue to avoid it. Look, I think you're okay here. I just I can't understand the moat, but I can't understand the moat for a $20,000 handbag either. So I think this is the, Birkin bag for pickup truck driving real Americans. And maybe that needs to be paid close attention to. I can't tell you not to own this, Vincent. I don't own it. I don't own it yet. That could change. I continue to think about owning it, and I continue to not own it. So that tells you everything you know. After years in the business, I just trust my spidey sense, and I'm perfectly super duper comfortable with missing out. Love missing out. Errors of omission are great. Errors of a commission, I will be very unaccepting of, especially when I commit them. All right, so let's take a look at Papa John's. We've covered this one many times as well. The reason I've never loved, I think you're going to be okay with this one, but ever since they stole the business from the founder and basically canceled him for stuff, I don't like that. The guy built the business, and bunch of strangers come in and tell them that they think they know better. So for me, I don't know. It just feels like a bunch of bureaucrats running the business. I guess they're doing an okay job, but I'd have to understand this better, but I never really got over that fact. And, maybe that's my bad. Obviously, many businesses do extremely well after the founders move on. But this one's got kind of flattish revenues. Balance sheet looks... Balance sheet looks a little levered to me. I'm going to pass on this one. Next is Lucas Cleas. Don't know that. Chris Savage. Mentioned biotechs. We'll have a good year. Take a look at BNTX. Solid pipeline, very cheap. Looks ready to break out. I tend to not buy individual biotech names. We own a basket of XBI. This is like Moderna. Pass. I have no edge on their pipeline. I'm a generalist. Paul Pesco. Okay, there's no question here. He's just telling me that OLED is bottoming and Payo has good fundamentals. So, okay, if you say so. Joseph Cook. Merry Christmas. Thanks for all you do. Thoughts on Yeti? We just covered that. Again, I have no objection to it. I'm just not going to own it. Okay, here's one. Don L. Hi, Tom. You always know that you're going to get a shitty AMA when someone puts a single letter for their last name. So, all right, Don L. How can you be confident in China's recovery when none of their stimulus works? Seems to be a fundamental issue with their system. I can be confident by looking past one day of headlines and looking out through history when financial conditions were this easy, what happened in the next 12 and 24 months. And the answer is a lot of good shit happened after financial conditions were this easy. So you can continue to read Bloomberg and that one writer at Barron's who seems to no longer work there if you want the negative story. But if you want the positive story, just stick to the facts. Have they fumbled the ball for 2+ years? You bet. But like all politicians, they make the right decision after exhausting all other possibilities, and it seems like they're at that point. They've done a lot of stimulus. They announced more last week, and we'll take it from there. Moving on to thank you for your informative videos each week. This is Richard L. Can you take a look at Evolution AB, Swedish ticker EVO, online casino operator, funnels its games, So all the profits are in Asia. All right, let's see. EVO. Okay. Sweden. Let's see here. Wow. That's some cash flow, baby. Revenues are growing, cash flow is growing, it's cheap. So yeah, all you got to do is figure out why is there a bearish story and what is it? Because I see nothing wrong with the financials. Let's take a look at the balance sheet. Yeah, I mean, what are the margins like on this business? All right, what's the free cash flow? Look, there's nothing not to love here. All I could tell you is you have to understand their moat, you have to understand their regulatory risk, and if it's trading down just because of Asia, I'd be a buyer, not a seller. But just who are their competitors? Balance sheet's great. Let's see if they've screwed anyone with dilution. How's the income statement? Where the hell's the income statement? Oh, here it is. All right. Little bit of dilution, nothing crazy given that growth rate. So Richard L., I think you got something here, but now the work begins. You got to understand their competitive advantage. Do they have a moat? Can someone come in and completely clip them? What is the bearish thesis? Why isn't it fully valued? And what's the bear case? And if you can get comfortable around all those things, I think you found yourself a good one. On to the next. Euro stock from Chris Davis, an undervalued copper play. I don't do commodity stocks in general, other than some gas and oil. No, thank you. Negative cash flow, commodity stock, no interest. Portillo's is getting cheaper by the day. We have Engaged Capital, same activists in VFC invested there. Thoughts about Portillo's? I like it. My kids like it. Haven't done anything with it. The numbers weren't great, but I think it's probably worth a punt in a personal account. This is not something I could sleep with for clients, but I do think it's turning around, and I do think it's a good product. And I kind of like it. So, and we've covered that a bunch of times. It got cheaper, so maybe now's the time to take a punt. But, like, would this be a high conviction? I love it. I've seen so many small burger chains come and go, BurgerFi, Habit Burger, blah, blah, blah. They're all public promotes, and they just dwindle out and die. I think Portillo's might be different, but Sean Desai, I covered pizza already. J. Smith. By the way, for Papa John's, I think it'll be fine, guys. I'm just not in love with it. J. Smith. Hi, Tom. I want to let you know I'm one CPS double away from being your client. Thanks for your opinion, not advice. My question is on QXO. Isn't there going to be one more dilution event when they make the deal? Shouldn't that create one more opportunity? Not necessarily. I mean, look, it's just a Brad Jacobs premium. I want to be involved with this. When we got in, if everything goes perfect in 10 years, it's an 8 to a 10 bagger. And if it doesn't, then I probably get out at a double and call it a day. But with him, things tend to work out. Tim D is also asking about Papa John's. So everyone likes Papa John's. I don't think there's anything wrong with it. Hudson Technologies, HDSN. Oh, this is interesting. What do they do? Let's see. HDSN. Looks like revenues fell off a bit. Let's see what they do. Provision solutions for recurring problems within the refrigeration industry, sale of refrigerant and industrial gas. Yeah, this is materials like Dow and all these stocks that are smashed. This looks like it should probably be a private company versus a public company. I tend to not play in these type of things. What's the market cap? 230 million. So look, the number one thing you got to figure out here is why they've destroyed shareholder capital for 30 years and why now is different. And if you can answer that question, then it's worth doing some real work on and pursuing. But when I see a business like this where it's just been constant destruction for 30, 40, 50 years, I'm not interested. So my best guess here is this is set up to benefit the founders, not the owners. And that's why the stock never does anything for 30 years. So tell me why I'm wrong and tell me what they've changed or who they've changed. And I'm listening, but revenues are declining meaningfully the last 3 years. And even though cash flow is still healthy, it's kind of a pass-through. Jonathan McKee, healthcare earnings expected to grow. And I've gone into Baxter, wondering your thoughts on Moderna. We've covered Moderna. Not for me. I can't understand their pipeline. Baxter is a little simpler. Its devices easier for me to understand. Can you take a look at Vale? I think we've looked at it. Again, mining companies, they have a tendency to just screw it up no matter how good the conditions are. My guess is what? You're buying it for the dividend? What's the dividend? I'm sure it's got a big dividend and that's why you're interested, because the stock's done nothing for years. I mean, the stock has been the same for, again, 20 years. Like, tell me why it's going to be different the next 20 years. It's a mining stock. All they do is screw things up. So, Vale. All right, so you got a 16% dividend yield. So that's why you're interested. Let's just take a quick look to get any sense if that is sustainable. Usually it's not. So their cash is down from 14 billion down to 4. And what are they doing here? Taking down their share count. That's good. Free cash flows coming down, but what is there? All right, their common dividends are $5 billion a year, and their free cash flow is 4.5, and their balance sheet is showing $5 billion of cash. My guess is that unless they hit a mining cycle, that dividend's going to get cut. You probably don't get hurt with the stock. It probably bounces back to 15, but it's not what I do. I think it's okay though. And with that said, let's see. All right, that's that. So with that said, we're going to be back next week, same time, same place. In the meantime, make a great... Let's try that again. We'll be back next week, same time, same place. In the meantime, make it a great one. Bye for now.